As investors, we often seek to own prominent companies that make the products we use every day. But this is flat out a bad idea. Today, I'm talking about Roper, a company completely transformed operating behind the scenes. Providing the infrastructure for some of the most important industries in the US, Roper is a company so integral to our everyday lives, and yet most don't even realize it. Our story begins in 1883 with the Moser-Whirl Stove Company, a stove and home appliance business. Dominating the early years of its history, the Whirl Stove Company became the largest stove producer in the world. With a sizable investment from the Florence Stove Company and a period in the 1940s to make artillery shells, business boomed bigger than ever. This incredible success attracted the eye of one of the largest retailers in the country. Sears eventually acquired a controlling interest in the stove maker, and after diversifying the operations across a variety of other kinds of home appliances, George Roper would come into the picture and reacquire the business from Sears. After a rebrand to Roper Industries, the company completely reorganized and growth was again explosive. While there's a lot more history, including the production of artillery shells again, and various legal battles for parts of the business, we're going to skip ahead to the early 2000s, where Roper again sought to reinvent and transform itself. The idea, presented by CEO Brian Jellison, was simple: transform Roper into a serial acquirer, using its large cash position to acquire cash-generative businesses. Roper let these companies run on their own. Later, it would collect the cash and use it to buy even more businesses. Pretty simple idea, and yet it's led to some powerful results. Primarily, Roper focused on acquiring technology companies, not stoves or other home appliances like you'd expect. We're talking insurance management platforms like Vertifone, medical devices from Verathon, and even the utility management company Neptune Systems. Its acquisitions were as weird as they were varied. All of these acquisitions served the purpose of removing the cyclicality from the business. The end goal was transformation, and Roper achieved that when it announced the sale of a majority interest in its industrials business, the very segment that built the company. The newly renamed Roper Technologies is a silent powerhouse in the world of technology. While many other companies attempt to be flashy in a bid to attract investor dollars, Roper decided to focus on maintaining technological infrastructure and making its product offering the best across the board. That's why so many may not even know that Roper has the software segment of the business at all. And this is why I somewhat resent the old advice: just invest in companies you know that make products you use every day. It's just got a lot of problems. Let's take Netflix for example. If you'd listened to this advice and invested in Netflix purely because you use it, you'd lost a good chunk of your money over the last 4 years. Depending on when you made that investment, it could have meant losing more than half of the money you put into the company. When this happens, what do you do? Where do you even start to look? You put your money into a company based on what seemed like common sense, but that common sense isn't common, nor does it make any sense. It certainly doesn't make any dollars. I watch this happen time and time again. Newer investors are encouraged to invest in companies that they know, only to watch the price drop dramatically, costing them lots of money. And this advice doesn't just go for Netflix either. We can look at basically any big company, from Starbucks to PayPal, Spotify to Disney, and so on. Investing purely off the advice of buying what you love is a good way to lose yourself a lot of money. That's why I think a better piece of advice would be, if you aren't going to do the work to really understand a company or stock, then you should probably just stick with index funds. Sure, this doesn't exactly roll off the tongue like invest in what you love, but I think it's a better line of advice for anyone. Now, speaking of understanding what you own, let's pivot back to Roper and take a look at its financials. Since 2017, revenue growth has been steady. No major jumps, just steadily compounding for the last 5 years. That includes 2020, where most software companies took off. Roper remained mostly unchanged. Interestingly, Roper's shares outstanding have increased. While the amount of dilution is negligible, it's a little odd to see such a mature company issuing shares. I guess I can understand Roper wanting to issue shares rather than pile on debt for every acquisition. This strategy might just be the right one in this case. As for free cash flow, it falls in line with revenue growth, which is great to see, although it is worth noting that in 2021 there was a large jump, most likely due to lower overall costs. I don't expect this number to grow as much next year and might even become negative. Unlikely to be negative in the next few years is return on invested capital. Last year, Roper's ROIC was a little low, 6.5%, with the average from the last few years being around 8% or under. Not great great numbers, especially given that ROIC has been steadily decreasing since transitioning to software. Moving on to debts, Roper has $12 billion worth with $3 billion due in the next 12 months. This can be covered by its total assets, which amount to $23 billion. Unfortunately, the company only has $351 million in cash, which is actually extremely disappointing. I'm not at all concerned that Roper will default on its debts, but I think it's weird to see such little cash coverage. Finally, we have dividends. Despite the fact that Roper steadily grew its dividend over the last 7 years, it only has a 0.56% yield with a tiny 16% payout ratio and a 5-year growth rate of over 12%. Roper can certainly grow its dividend given its transformation into a higher margin software business. I hope there will be increases moving forward, and aside from that, the low ROIC and low cash pile somewhat concern me. Still, it's a good balance sheet overall, definitely not a fortress, but good enough. On that note, I think it's good to talk about Roper's change to software instead of industrials, because it's building out one of the most impressive software offerings on the market, and it seems like no one even knows about it. Back in 2015, Roper cemented this transition by changing its name to Roper Technologies. But what technologies does it actually own? Roper divides its various companies into 3 buckets. The first and largest of these is application software. Companies in this first bucket include Adirant. Think Adobe Creative Cloud, but for law firms. Vertifone is another business offering a platform to streamline the complicated process of buying insurance, both on the business and end consumer sides. Clinisys offers services that allow healthcare workers more efficiency in diagnosing patients. Application software will account for more than 50% of Roper's portfolio moving forward. A couple of businesses from its second bucket, network software, include iTrade Network and Construct Connect. The first helps restaurants streamline the food ordering process and manage inventory easier. On the other hand, Construct Connect helps construction firms find financing for pre-construction projects. The third bucket, technology-powered devices, includes companies like RF Ideas and Neptune. RF Ideas makes RFID-powered identification cards and software. You can think of this like those locks on doors that require a key card to open. This technology is used in various other applications in an office setting. And Neptune is an endlessly interesting company making technology-powered tools to help municipal water companies streamline their business. All of these companies make up a small minority of the total number of businesses and verticals that Roper operates in, and by design. See, Roper is what we call a serial acquirer, a company whose primary job is to go out and acquire more companies. I talked about another one of these types of companies a little while ago called Boston Omaha. The same general ideas apply to Roper. What's really important is management. The people making the acquisitions will make or break the company. If the corporate team makes poor acquisitions that don't add value over time, it could very quickly destroy the business. Thankfully, management's approach to acquiring businesses is very much so like Berkshire Hathaway's. The core philosophy is to buy incredible companies and let them continue to operate on their own with little to no influence from upper management. Another thing sticking out to me about this management plan is the goal of acquiring businesses with a heavy focus on recurring revenues. The subscription format has become fairly popular in the last few years and is Roper's dominant form of income. With more than 80% of Roper's software revenue being ultra-high margin recurring revenue, the company has plenty of financial firepower to acquire more businesses. This is part of the reason I was thrown off by the little amount of cash on the books. I expected a lot more given general software margins. Another way we can gauge management success is by looking at previously acquired companies. The most high profile of these, of course, is the segment that was just sold off by the company, the industrials. In 2004, Roper acquired TransCore for $600 million. Recently, the company announced a deal to sell this asset for $2.7 billion, representing an 8% annual growth rate of the 17 years they own the company. It's a fairly decent rate of return, but Roper's best return comes from a deal in 1998 to buy Acton Research for $10 million. A few years ago, Roper sold a segment of Acton, Able Pumps, for over $100 million, a CAGR of over 10%. So we see that Roper at least has a history of finding good companies, holding onto them, and growing the business, and therefore its value. And there is certainly no shortage of businesses for Roper to acquire. The company reports there are over $7 billion worth of potential acquisitions. Now that Roper's fully transformed its business, it's worth taking another look at. Serial acquirers are some of my favorite businesses to examine. While the risks are certainly very high, the rewards are often steady compounders that virtually never never stop. Especially now, since the last cyclical part of the business has been removed and gave Roper over $2 billion of financial firepower to make more acquisitions. On the surface, there are no obvious signs of it slowing down either. In fact, for a company of Roper's size to grow revenues organically by mid-double digits is rather reminiscent of Microsoft heading out of 2008. On that note, if you want to help the organic growth of this channel, be sure to like and sub for more. Of course, there are still risks to this method of doing business. Management really can make or break a company. While Roper hasn't had any major write-downs from acquisitions yet, it doesn't mean that the company won't in the future. As I have said time and again, with acquirers, the main bet is on management's ability to make good acquisitions that strengthen the business. And interestingly, despite the large sale of TransCore earlier this year, Roper has yet to make a substantial acquisition this year. Despite management's confidence in their supposed $7 billion company pipeline, nothing really has come of it yet. This is further compounded by the rout of equity valuations as well. Some of the largest tech companies in the world have taken haircuts to their valuations. This is seemingly a perfect chance to start making deals, and yet nothing. Very odd. Yet one of the most interesting risks to Roper is actually cyber attacks. While any software company is susceptible to these attacks, Roper is a little different. Given its internet infrastructure status, this makes the company a resoundingly perfect target for foreign powers looking to cause chaos and damage. Not only would infrastructure in this country be severely affected, but it could possibly lead to companies wanting to renegotiate their contracts with the company. Think of this as the SolarWinds risk. Plus, as I was researching, I decided to take another look at the company's debt, and it's actually worse than I thought. One of the quickest ways to figure out if a company is using too much debt is to take its free cash flow and compare it to its total debt minus its cash. This gives you a fairly accurate and fast way to see if there could be a debt problem. Usually you want to see this less than 3 times free cash flow compared to debt. Turns out that Roper has nearly 6 times free cash flow to net debt. In other words, it would take 6 years of Roper using all of its free cash flow to pay off these debts. That's not a very favorable position for any company to be in, and it worries me considerably. While most of this debt is from purchasing Vertifone, I think the wisest thing to do is just to wait for Roper to get its debt under control before you consider investing. But other than that, I think Roper Tech is a tremendous business that is both stable and has large growth prospects, with the only big issue being debt. And so that leaves us with the question, am I buying Roper Technologies? And the answer is yes, but in the future. I would like to see how Roper's go-forward tech portfolio fares in the next couple of quarters. This, along with seeing the company continue to pay down debt, are the big factors in my decision to invest. In terms of valuation, I get a fair value of $380 to $400 a share, so the company's a little overpriced as well. But that's all I've got for you today. If you enjoyed, I'll bet you enjoyed the video popping up on screen now. Also, be sure to leave your thoughts on Roper in the comments below, and as always, this is Dollars and Cents.